Hello, in this short video we're going to have a look at rules. Before we start talking about the rules, let's talk about the kinds of rules. So there's two kinds. One are those that are compulsory, and these cannot be changed. For example, section 8 and 13 and 17, which we've looked at. And those that can be changed. Now, how do you know? How to tell the difference? It uses words such as subject to any agreement. Now, if we look at, in particular, those sections are around about 20 through to 27, relationships of partners one to each other, you'll see that if we talk about variation by consent of terms of partnership, the partners can change their rights and duties by agreement defined by this Act may be varied by the consent of all parties. Now, the key thing there is it's the consent of all parties. And so once you enter a partnership agreement, you have an agreement in place. You cannot change it without unanimous consent, which in itself is a bit of a problem. Now, if we just follow through some of these sections, going back to the rules themselves, and start with section 27. Now, at the start of section 27, it says, subject to any agreement express or implied between the partners, we have the following rules. So this tells us we can change any of these particular rules. Well, when we look at section 27, you can see there are a substantial number of rules. Now, if we just go back here, how to change. The only way is by agreement. Use of a partnership agreement or proof of agreement. So it is by conduct or by actual agreement. In a practical sense, this really means you need to have it in writing. The real question then becomes, what would we change? And that very much depends on your objectives. Which is what you're doing in the assignment. So what do we want? How will our business work? And therefore, what changes do we need to make to these rules? So if we go back to the Partnership Act and just look at some of these in turn, all partners entitled to share equally in capital and profits of the business and contribute towards losses. A lot of people change this because the contributions of each person may be substantially different. Just make that a wee bit bigger. The second one down there, 27B, must indemnify partners for payments made, liabilities incurred. The word indemnify means make up a loss. That means that if a partner expends money on any activity which is reasonably necessary for the business, the other partners have to pay them their share. This can be a problem, and it's not unreasonable to put limits on that without consent of the other partners. You'll notice here it's for in the ordinary proper conduct of the business or necessarily done for preservation of property. Third one down here, partner making payments or advances beyond their contribution gets a 5% per annum rate of return, which is a fairly high rate of return at the moment, and interest rates do change, so people often change that to a percentage, being the average of 3 of the major trading banks, for example. Number D is a particular issue. Partner is not entitled to interest on any capital subscribed by him or her. So the contribution you make as capital is an investment without any interest. The idea there being you receive your share of profit for putting your money in, but you can in fact receive a payment of interest on that amount as well. E, partners take part in the management of a partnership business. Again, you might want to change this because you've got a lot of partners and it's not practical. The default rule is everybody gets to take part in management, which means the business is run by a committee, which is generally not a good management structure. However, if one person is elected to have power as the manager, it may be difficult to have your say. In F, no partner is entitled to remuneration for acting in the partnership business. That simply means you can't get paid for your role as a partner unless you put it in the partnership agreement. The reason behind that is partners are in a partnership to share in profit. And if one partner is paid a salary, they may be motivated to maintain their salary or their job rather than grow the business for the benefit of all the partners. So that can be a bit of a problem. Most people who work in a business full-time will need paying, but you need to think carefully whether the partner should be paid or not. No person may be introduced as a partner without consent of all existing partners. This one is a problem for raising capital. One of the ways to raise capital is to introduce new partners, and you will need to change this if you want to have a majority making that decision. Now, the issue with this, in addition, is that you can end up with partners being introduced you don't agree with. So 3 partners, 2 vote for a new person, 1 votes against, and you have an additional person in the partnership who you would never have gone into business with in the first place had you had the option to make that decision. So you need to think carefully, do we need to have this open to allow new partners in to raise capital? But what about limiting who can be brought into the partnership? You may think up some clauses you could put in the assignment to deal with that issue, such as reasonable liquidity of the person, passing some certain tests, having some qualifications, or other requirements you may have you think are necessary for the business. Some people put in the person should not be a relative. H, any differences connected with the partnership business are decided by a majority of partners, but no change made in the nature of the partnership business without consent of all. So in day-to-day matters, you vote, and it's majority rule. Of certain decisions you may want to be unanimous, such as large loans or purchase of capital assets. And so you may put restrictions in the partnership agreement saying unanimous for certain levels of expenditure or certain types. The nature of the partnership business is the core function, what it does. If it's a building company, then the decision to suddenly become a tourist operator taking tramping trips in the Waitakaris would require consent of all partners. The final one's fairly self-explanatory. We need the partnership books useful. Now, if we go back to the contents, past section 27, you can see other rules which are useful. Expulsion of partners. Should we be able to remove a partner we don't like or for other reasons? The default answer is no, and if that's left that way, the only way you can expel a partner is either get their agreement or go to court and have the partnership dissolved. You can't ask the court to remove that person, you can only ask the court to dissolve the partnership, which of course is disastrous for the business. Now, when you make this decision, think carefully about whether it would affect you, as you may be the person the other partners want to expel. Retirement from partnership at will. We discussed this one elsewhere. When no fixed terms been agreed, any partner may determine by the partnership on notice. So it may be best to change this so that we require notice of a specific time with a specific mechanism to pay out the partner. Now, further down here, we'll just cover these since we're currently there. Duties of partners. Remembering partners are fiduciaries, so they have to act in the best interest of all other partners, but in addition, we have some specific duties. To render accounts, to account for private profits. Again, can be a tricky area. So a private profit is any benefit derived without the consent of the other partners. So receiving payments from creditors is obviously a private profit if it's not disclosed. Any gratuities, meaning gifts from suppliers, any benefit is a secret profit or private profit which must be disclosed and accounted for to the partnership. It can also be a criminal action under the Secret Commissions Act. Okay, now those are the major issues or main areas to consider with varying the terms of the partnership. And remember, these rules, although they will not affect outside parties, third parties without their knowledge, are useful simply from a pure management perspective in running the business properly. And they do allow one partner to sue another for breach of those agreements if it results in a loss to them. So work through your assignment and decide, what am I trying to achieve? Do the default rules achieve what we want, or should we change them? And what should we change them to?